Hey everyone, Karan here from Life Accounting, where we help you save on taxes and increase your wealth. And by the end of this video, you will know every business loan type available to you as a small business. I'll be covering loan eligibility, needed documents, and how to compare loans so you get the best terms. Let's dive in. Okay, so there are many reasons why you may be interested in getting a loan for your business. To start the business, for working capital, for cash flow, for equipment, for emergencies, the list goes on and on. So let's start by understanding the types of lenders and loans available to you. The age of your business, the revenues of your business, and how fast you need the cash will influence which lender and type of loan will be the best for your business. There are three main types of lenders for a small business loan. First, there is the SBA. The Small Business Administration offers different types of loans for small businesses. And the biggest benefit of an SBA loan is that the SBA partners with lenders to provide loans and guarantees 75 to 90% of the loan for the lender. This results in better terms and easier qualifications for small businesses. Now, the downside of a business loan from the SBA comes in the form of increased paperwork and approval speeds that can be slower than other lenders, which makes an SBA loan best for any business that can weather the time it takes to get approved. Next, you have conventional banks. These are the regular everyday banks that provide loans to businesses. Think Bank of America or Chase Bank. Now, conventional bank loans generally have the best terms regarding interest rates and fees when it comes to small business loans. But the biggest downside of a business loan from a conventional bank is how difficult it is to qualify and get approved, especially for new businesses. So a loan from a conventional bank is best for established businesses with consistent revenues. All right, next we have alternative lenders. These will be your online lenders of capital for businesses. So what are the benefits of an alternative lender or online lender? Well, loan approvals typically take less than a few hours and funds are provided in less than a week. Alternative lenders also have the easiest eligibility requirements and less rules for the use of the funds. Which brings us to the downside of using alternative or online lenders. To make up for how quick you can get approved and funded, they typically offer the highest interest rates and fees compared to other types of lenders. But because it's so easy to get funding, alternative lenders are best for startups or business owners without high revenues. And popular alternative lenders include Cabbage, Funding Circle, Blue Vine, On Deck, or Fundbox. Okay, so we went over the lenders. Now let's talk about the types of loans you can get for your small business. First, bank loans. These are loans provided by conventional banks, and the benefit is that they typically have the best interest rates out of all loan options. But the downside is strict qualifications needed to qualify. You'll need great credit in an established business. So loans from conventional banks are best for established businesses with good credit. And these are going to be your popular lenders once again, like Bank of America, Chase, or Wells Fargo. Then we have SBA loans. And I first want to talk about the 7A loan, which is a loan program backed by the SBA for up to $5 million in terms up to 25 years. Now, the biggest benefit is that there are over 6 different loan programs to fit your needs. But the downside is that to qualify, you need at least a 690 credit score, 2 years in business, and consistent revenues. So once again, this loan is best for established businesses with good credit who don't need funds quickly. Next, we have microloans that are very accessible for businesses without large revenues or good credit. The downside is that the process can take a few weeks, a business plan is needed, and collateral against the loan is required, as well as a personal guarantee. So this is best for startups or small businesses who who have bad or no credit history. The next type of loan from the SBA is a 504 loan. And these are loans up to $5.5 million for the purchase of commercial real estate, land, and equipment with terms up to 25 years. Now, the biggest benefit of these loans is the relatively low interest rates and small down payment of only 10%. But here's the downside. It's a lengthy process with involvement from both a bank and an SBA approved certified development company, also known as a CDC. So this is best for established businesses who need to purchase equipment or buy real estate. Now, the next type of loan you can get is called a term loan, which is a lump sum paid back in fixed increments over time. The biggest benefit is that it's fast, has online approval, and fund disbursement with a consistent payment schedule. The downside is that interest rates and fees are typically higher than conventional bank loans or an SBA loan. So this type of loan is best for startups or business owners with not so great credit. And popular lenders include Cabbage, Funding Circle, Blue Vine, On Deck, and Fundbox. Then there's the line of credit, which is a fixed and flexible revolving access to cash up to your limit. The benefit is that interest is paid only on the amount drawn. And once you pay it back, the funds are immediately available for use again. The downside is that fees can be costly and borrowing amounts can be lower than with a loan. So this is best for all businesses who can qualify, and popular lenders of a credit line includes Cabbage, Blue Vine, and Foundation. Our next type of loan is called Invoice Financing, which is a cash advance, typically 50 to 90% on unpaid invoices. It's actually not a loan, but the biggest benefit is that it's easier to qualify for than other loan options due to the invoices being collateral. The downside is that fees can be greater than other loan options and funds are dependent on your sales continuing. So this is best for businesses with consistent sales, and popular lenders include Blue Vine and Fundbox. Then there's the merchant cash advance, which is a cash advance on unpaid credit card sales. The benefit, bad credit or minimal business history can still qualify. The downside is that this is the most expensive form of financing available. So it's best for businesses who have exhausted all other loan options. And popular lenders include Rapid Finance, Can Capital, and even PayPal. Then there's equipment financing, which is loans specifically for purchasing equipment. The benefit, low interest rates, fixed monthly payments, and leases may be available for the equipment. The downside is that funds are limited to only purchasing equipment. So this is best for businesses who need equipment and don't want to purchase up front. Popular lenders include Crest Capital, Balboa Capital, and Currency Finance. Now, let's talk about secured versus unsecured business loans. No matter what lender or type of loan you decide to go with, the loan will either be a secured loan or an unsecured loan. Secured loans use assets as collateral or recourse in case you default on the loan. Collateral provides some form of protection for the lender and generally results in better loan terms. And common types of collateral include real estate, equipment, cash, cars, outstanding invoices and payments, and even future revenue. The amount of collateral needed will vary depending on the lender, the type of loan, and the loan amount. Unsecured loans do not require collateral and are therefore more risky for the lender. The higher risk typically results in stricter requirements and or higher interest rates. Now, you can't just walk into a bank and get a loan. You'll need a few documents first. And no matter what type of loan you apply for or what type of lender you go with, here are the documents that you may need to provide. Tax returns. This is going to be personal income tax returns along with business returns if applicable. This may also include K-1 statements for partnerships or an S corporation shareholders. Next up, you have income statements and balance sheets, which are financial documents that provide a snapshot into the business performance, assets, and liabilities. Then you're going to need business and personal bank statements. You're going to need business legal documents also, which are business certificate, licenses, and contracts if they apply. And lastly, a business plan. All right, let's talk about loan eligibility. Each lender and loan type will have their own specific requirements, but most take into account the 4 C's. The first C is capital, your ability to repay by looking at your business and or personal earnings, savings, and debt. Then there's credit, which is the credit history of your business and or you personally. Next, we have collateral, which are assets that can be used to secure the loan if it is a secure loan. And lastly, conditions, which is the purpose of the loan, time in business, and industry of the business. Okay, so you understand the types of loans and what you need to get a loan. Now let's talk about how to compare lenders. Okay, assuming you qualify, when comparing 2 or more loan options against one another, look at the following items to determine if it is the best option for you before signing the dotted line. So first, look at the interest rate and APR. Interest rate is the annual cost of the loan as a percentage. APR is the annual cost of the loan plus any fees. Next, ask yourself, is the interest rate fixed or variable? Look for additional fees like application fees, origination fees, servicing or process fees, non-sufficient fund fees, closing costs, prepayment fees, late payment fees, administrative fees. Just look for the fees, both hidden and not hidden. Next, take into consideration the fund amount. What is the max amount allowed to borrow? Next, look at the repayment terms. How long will you have to repay the loan? How often do you have to make payments? Is there a balloon payment? How much is the monthly payment? What collateral is needed? Is the loan secured or unsecured? And if it's unsecured, what collateral is needed? Okay, let's look at a loan comparison example. Notice how loan B has lower monthly payments and a longer term, though it results in a larger amount of interest paid over time. So don't be fooled. Once again, look at the loan amount, the APR, loan terms, monthly payments, interest paid, and also fees. I'm going to place a few videos on the screen I think you should watch next. Be sure to check them out. Also, if you found this video helpful, do me a favor and hit the like button for me. It helps others to find this video on YouTube. And subscribe to the channel for more information that helps you save on taxes and increase your wealth. I'm Karan from Life Accounting, and I'll see you in the next video.